Hello and welcome to this annual update of Shin Nippon, the specialist Japanese small cap investment trust. I'm Praveen Kumar, the manager of the trust. Japan has been in the news a lot recently as its stock market is trading near all-time highs. This has generated a lot of investor enthusiasm. However, high-growth small caps have been a notable absentee from the ongoing rally which began about 3 years ago. This rally is being driven by three broad themes: improving shareholder returns and corporate governance, the latter boosted by increased private equity activity in Japan, interest rate increases, and finally, a very weak currency. In practice, this means that most of the best performers have been large cap businesses that are either cyclical, capital intensive, sensitive to interest rates or currency, or those with significant unproductive financial assets on their balance sheet. To our mind, most of these are not secular growth businesses. All this has meant that high growth small caps have been massively out of favor. There seems to be very little interest in this asset class, even amongst domestic retail investors who have historically been the main buyers. We are now in a situation where numerous companies in the portfolio are growing their sales and profits at well over 20%, but are now trading at extremely low valuations. We are also finding loads of new high growth ideas that have become very lowly rated. We think this is an excellent starting point for potential future outperformance as and when high-growth Japanese small caps come back in favor. As noted in the annual manager's report, Shin Nippon underperformed its benchmark for the year ending January 31st, 2024. We are very disappointed with this result, and we understand the frustration of shareholders, of whom I am one. Most of our rapid growth online businesses continue to grow their sales and profits at an impressive rate, but still saw significant share price declines. Letalico is a classic example. It provides online training and placement services for adults with disabilities, an area with huge growth potential. Sales grew by 26% and net profits by 118% in the first 9 months of the company's current fiscal year, and yet the share price fell nearly 30% over the year to January 31st, 2024. Online funeral services provider Kamakura Shinsho had a similar story. Sales growth of 17%, operating profit growth of 19% in its most recent full year, and management are forecasting even faster sales and operating profit growth for the next year, 24% and 35% respectively. Yet, the shares have almost halved over the past year. Strong sales growth, expanding profit margins, even faster growth forecast for next year in many cases, and yet the shares being sold off aggressively. This pattern was repeated across numerous holdings in the portfolio over the past year. Given a high growth-oriented investment philosophy and style, our portfolio is naturally skewed more towards such fast-growing businesses. Significant and sustained share price weakness of such businesses in the portfolio was unfortunately not offset by portfolio holdings that did do well in relative share price terms, leading to overall underperformance. It would not be an understatement to state that high-growth Japanese small caps continue to experience a torrid time. However, there are reasons to be optimistic about the future. Firstly, there is the simple case of fundamentals asserting themselves. Cyclical and currency-sensitive large caps, which have done exceptionally well over the past year in share price terms, have seen their valuations reach at or near all-time highs. We believe this to be at odds with their long-term growth prospects, which remain decidedly average. In contrast, valuations of small caps in general have compressed significantly. Shin Nippon's high-growth portfolio trades pretty close to the benchmark despite having delivered superior sales and operating profit growth over the past 5 years and forecasted to do so again over the next year. Second, in relation to improving corporate governance and rising shareholder returns, it appears to us that most of the easy gains have been made already, and these are reflected in the strong share prices of such companies. From here on, we really struggle to see any positive catalyst for such companies as these are not growth businesses. This could potentially result in investor interest coming back to growth small caps. Third, with the Bank of Japan moving to normalize interest rates in Japan, we could eventually see a strengthening of the Japanese yen, which in turn should be positive for domestic-focused businesses. The good news is that the majority of Shin Nippon's holdings generate almost all of their sales from Japan, so the portfolio is well positioned to benefit from this scenario. In conclusion, I would like to acknowledge the frustration and disappointment shareholders have had with Shin Nippon's poor performance. As I've discussed, this is largely down to external factors out of our control. Although this period has dented past performance, it has, however, provided a unique window of opportunity for us to double down on cheap and attractive long-term secular growth stories that we are confident will outperform the benchmark going forward.